Hello everyone, Chris Guthrie here from upfuel.com, filming an updated review for Wealthfront. I first signed up for Wealthfront back in the middle of 2014, and so I figured 3 years later is a good time to give you an update on how Wealthfront's been going and share some of the new things that they have in the account as well, and then also just tell you a little bit more about the company if you're not familiar. So if you don't know what Wealthfront is, they're a Robo advisor, and basically what they do is they help automate the process of investing in a variety of different index funds based on what your risk tolerance is. And so you can either do a retirement account, you can do an individual account that's after tax. And so there's a variety of different account types that they offer. You need $500 minimum to be able to open an account with Wealthfront. And if you want to sign up, you can click the link below this video, and I'll have a link below there which you can use to sign up. And then when you use that link, you get an extra $5,000 in assets managed without having to pay any fees. And then I get an extra $5,000 managed without having to pay any fees as well. And so that's what's in it for me and what's in it for you. So if you're not familiar with Wealthfront, and if you want to learn more, I'm going to show you some more of what what it's about. But I wanted to briefly talk about index funds in general. If you're not familiar with what they are, basically the philosophy is that you should try and match the market performance and not try and beat it. And so instead, what you should do is to lower your fees as much as possible, because it's hard to beat the market and most people don't, right? And so that's the philosophy. And so as an example, from someone that's much smarter than me, Warren Buffett made a bet almost 10 years ago, and it said over a 10-year period commencing on January 1st, 2008 and ending on December 31st, 2017, the S&P 500 will outperform a portfolio of funds of hedge funds when performance is measured on a basis net of fees, costs, and expenses. And so I'll cut to the chase and just show you what the returns look like after year 9. And basically the hedge fund has returned 22% and the S&P 500 index fund has returned 85%. And so Warren Buffett and what many other investing people say is that for the majority of people that are investing, it's better to just try and match the market, use something like an index fund, than it is to try and beat the market, because as this example showed, it's hard to do that when you have hedge funds, for instance, that charge 2% annually and then also charge 20% of the profits as well. So they're charging so much in fees, it's hard for you to actually make any money. Mutual funds aren't that high, of course, because they're usually like about 1% or so. But hedge funds in particular are really high. And just in general, Warren said, look, it's really hard to beat the market. Most people will never do so. And so instead, match the market, reduce your fees as much as possible. And so that's just like the really high level overview argument for index funds. And then of course you can go out and look at the argument against index funds as well if you'd like. I invest in index funds, and I also invest in a handful of individual stocks at this time. And then beyond that as well, I invest in all my businesses and other things besides that. Okay, so getting back into Wealthfront, again, you need $500 to sign up for an account. Really simple. You can use the link below this video. But I want to show you just a couple of different accounts. Obviously, the performance of the accounts that I'm going to show you is not indicative of what you might get, because in the past, the markets have been going up, but as of this video, the markets may be down. They may continue to go down, and that's just part of what it is. The goal with investing is really to continuously and consistently invest for the long haul. So SEP IRA, it's great because you can put, if you have a SEP IRA, you can put up to $54,000 in 2017 into that, and that reduces the taxes that you pay for that tax year. You need to make a considerable amount of money to actually put that much in, because the IRS only allows you to put in a percentage of your income. But if you set up a SEP IRA like I've done, then you can contribute a fair amount. I have another business partner, and we have a separate SEP IRA through another company. And so I haven't done any new deposits into my Wealthfront account because we'll cap out the $54,000 through that other business instead. So long-winded to show you what this looks like. It's kind of cool when you go along here, you can see, oh, we reinvested your dividend at $405. So it's nice. You get dividends, reinvest it back into to buy more and to invest into more things. And so every one of these little circles is a dividend reinvestment. So it's kind of cool to see those. You can see performance year over year, and you can also see what it looks like all time when you check that one. Now, the way that they actually balance the assets is based on what your risk profile is, like I mentioned in the beginning. So this is 7 out of 10. And so in a retirement account, this looks like 20% US stocks, 17% foreign, and then on down from there. Now, if you're in a post-tax account, they actually do things somewhat differently. And so you can actually look, Wealthfront talks about why they balance them differently for retirement and for taxable accounts. But that's what this does here. Okay, So coming into the post-tax account, so here's one account that I set up. It's 10K a month. And so you can see here the US stocks is 35% as opposed to the 20% in the SEP IRA, even though I have the same risk profile of 7 out of 10 for this account. Another thing that's different about the post-tax account is that you can take advantage of something called tax loss harvesting. So when I filed, when my accounting firm filed my taxes for the 2016 year, they were able to recognize a loss of $1,618, which reduced the amount of taxes I had to pay. And from a very high level overview, what tax loss harvesting is that, let's say for instance, you own Coca-Cola stock and Coca-Cola stock drops, Wealthfront then would be able to sell that stock and then buy another stock that's similar like Pepsi, and then you're able to recognize that loss, but then still be in the same underlying type of asset as well. So that way you're not, shifting completely out of that market. Now I somewhat butchered that because again, I'm not a professional investor. You can read about tax loss harvesting both on Wealthfront and elsewhere. But that's one of the cool things about post-tax accounts and then using a robo-advisor like Wealthfront, and others do this as well, is for the tax loss harvesting. So it's able to reduce your taxes when you're doing that investing, even though net for 2016, the account was up 7-something%. So that's how that works. The other thing that's kind of cool is the path. Now I haven't played around with this that much. Frankly, I just kind of made a few changes to it for the purposes of this video. You can hook up your other investing accounts. I haven't done that. This is just Wealthfront for me. But you can say, for instance, I want to retire when I'm 40, and then you can see, how much money will you have if you continue to do the investing that you have been doing, and then you can set up how much spending you would do and all that. Not that I would plan to retire by that age or anything, but that's just something you can play around with, and it can show you, how well that will do, and it shows you what the assumptions are based on what the returns would be for your portfolio and everything else like that. So in that case, I would need to invest more to be able to spend that. The other thing I want to show you is they also have something called portfolio line of credit. So if you needed money for any specific reason and you have a post-tax account, they can actually use that account as collateral, and then you can borrow money. So in this case here, I can borrow $46,400 on this $155K that I have in this account. So that's pretty much it for Wealthfront. I just wanted to show you kind of high-level overview what the accounts looks like, show you some of the features, and talk about it from the perspective of someone that's been using it for several years now. Again, if you sign up for Wealthfront, I don't get paid anything as of the recording of this video. Instead, what I get is just I get extra assets managed for free as opposed to having to pay fees on those. And then Wealthfront's fees, I don't remember off the top of my head, but they charge some fees for the process of doing all this, right? The tax loss harvesting and the automating of the investing and all that. But it's fairly low. I wish I knew off the top of my head. Anyways, you can go ahead and sign up for Wealthfront, clicking the link below this video. If you have questions, you can post in the comments area here, and I'll do what I can to reply to those. And if this helps you decide to sign up, great. If you use someone else, that's great too. I'll link to other robo advisors that you can check out below this video as well. Thanks for watching.